Hey there, welcome to the channel. So today was our big Fed day. So basically, if you kind of look at it, we'll just take a quick look at the charts here and see what's going on. Okay, so the Fed had their, announcement today in press conference and all that. And if you kind of look where we're setting up now for the week, if you look in the SP, we kind of have a doji here on the week. So, we've broken those moving averages but it's kind of like, sort of the arrested the fall right now. That's kind of what we see if we look in the weekly. Your tech stuff is weaker than some of the other stuff. Your speculative RK stuff is, definitely kind of in a bear market there. It's well below these moving averages and that whole deal there. And the IWM has, more recently kind of broken down, and you have kind of the death cross going on there. So basically, let's look at the daily here. And let's look at a little bit more like this. Yeah. So, it's kind of expected to have volatility. So I think what the Fed basically did what they said they were going to do, right? They didn't come out. There was speculation in the market that probably caused a lot of this pain earlier in the week. And that pain may very well have been caused by the fact that there started to be, so a couple of days ago, like on Monday, you have this kind of speculation and everything. There's this, I don't know if people got panicked or whatever, but there was speculation that, oh, maybe they're actually going to accelerate their taper and they're going to end their tapering early, so then they might raise rates early, and then they might go ahead and basically start increasing rates early. Well, that didn't happen. They basically stuck to their guns, like, hey, we're tapering, going to end the tapering March. First rate raise looks to be something like April. It was interesting that they were asking, and they were commenting, like, the questions they were kind of really trying to get out of him, whether he would consider doing more than just a 25 basis point increase. And what was kind of interesting is, like, I believe two different reporters asked him the question, and he kind of like talked around it, but he really pointed out something important. He pointed out, hey, this is different than what we were doing in 2016, because the difference now, okay, so he pointed out the difference in 2016 when they were raising rates, they had low inflation. Inflation was only like 2%. Here it's much more than 2%, which actually it's like more like, basically it's like 7%. Yeah, so he was kind of talking around the issue, the question that was being asked. And what they were asking is, they were like trying to say, hey, is there a possibility you're going to increase rates by more than like 25 basis points at a time, given that the inflation that we have? Now, what he did is he didn't really poo-poo that. If you look at it, what he had said is he had specifically called out that when they were raising rates over here in 2016, going into 2019, that we still had this low inflation. We still only had like 2% inflation. So it was not as hot as it is now. Right now, he said inflation is considerably more, but we know that inflation is 5-7%, much higher. So he said, he sort of implied that is different. That's one thing that's different this time. So if you go back here, they really, in modern times, more recent times, they always try to raise by just 25 basis points, slow, methodical changes. And that's what they were doing here. But from what I could tell, is like he did leave it open. He really did kind of leave it open to be like, well, we might do 50 basis point. He didn't say that, but he left that open. So in the end, so if we look at like how things traded today, basically is kind of flat. If you really look at it, and given all the hype and the concern about what's happening, it's kind of like just a really flat day, down 0.25%. So you just had a lot of volatility, a lot of, intraday, little churn and stuff. And then if you look at it, as he, it was kind of flat, and then it kind of was okay. And then there's a little bit of selling, but really not a lot of selling. I mean, that's not a lot of selling given to the fact that he, kind of held his gun. He didn't he still was hawkish the same way he's always been, and he kept up with it, right? So he didn't change anything. There was no surprises, no curveballs, anything like that. So the market kind of expected it. It sold off a little bit, but that's kind of, fine. That's kind of what I would expect. So in the big picture, going back to that, it really does seem, we just seem like we could be in that. I still, it sort of looks to me like we still could be transitioning into that bear market. The Fed has, when you look at the history, inverted yield curves seem to, just looking at the charts and looking at the yields and the stock market, like they always overdo it. They always overdo it. They're never able to get it right, and it's just because we've had so much time that they're basically been relying on this, that it's just very difficult, for the markets to adjust to that. We've been down at zero since 2009. They did get the rates up a little bit in 2017 to 2020. But then we've been down here for a year and a half at basically zero again. So all this time, the entire economy, it just needs those lower rates. So for them to get them back up to some other number, even 1.5%, 2%, it's going to be very difficult for the economy to handle that. Very difficult for the stock market to handle that. It's just a totally different game. So, screw it. So screw it. It's like, it is what it is. They did what they said they're going to do. Given those charts, looking at those charts, they're still kind of oversold in the short term for sure. So, it wouldn't surprise me to see some kind of a rally here, because why not? It's like, if, the worst effects of the rate increases are still a little ways off, right? You can kind of see that they could still be a little ways off. Yeah, they're going to do their tapering. The tapering, that's a really good question. We'll see what happens with the interest rates, whether, there really is an additional kick up in interest rates because of the like a lowering in demand for bond purchases. But it's really hard to say whether that's going to be the case, but that would be something to watch out for. So for example, if you saw the yields on treasuries start to go up, indicating that there's less demand for those bonds, aka the price is going down, and we kind of, imagine people will be watching like the auctions and kind of seeing like, is there still good demand for the auctions, et cetera, like that. And that would be an area where you could see that things are tightening up, as the Fed reduces from over like 120 billion a month of basically bond purchases to nothing in a rather short time. It's only going to be within 3 months that they're doing this, through 4 months. And that's a pretty short time. So what does that mean? We have really huge deficits, and you have to remember that our budget deficits, when you look at the budget deficit, it's almost irrelevant. The budget deficit isn't the issue. The issue is, where is the actual physical deficit? Where's the cash flow deficit? Where do they have to raise bonds? Because the issue is that you have to remember that every month they have to roll over a lot of this short-term debt. A lot of our debt is 3-month debt, 2-year, 5-year debt. So this stuff is constantly rolling over. So when you look at it and you say, well, we increased the debt by 4 trillion last year, and we're still increasing it this year. And the year before we raised that, how many trillion? We're still paying for all that debt. It's not like we wrote that debt on 30-year bonds. Very little of it was sold at that rate. And you go look that up, and you'll see that like most of it is on shorter term. Because why? Because it's expensive, and who wants to go ahead and buy 30-year debt and hold on to it? You don't really want to. There's not as much demand for that. You can take the risk and lose money on 2-year, 5-year debt, and then 20 or 10 is a little more tough, but there's just a lot less demand for that. So that's what we need to see what happens. So I would keep an eye on basically the bond auctions, see if there's demand. There will be, on the back end of it, they're not going to let bond auctions fail. They're always going to happen. They have enough primary dealers to fill that. The primary dealers, though, however, that's where you watch the repo market and you watch what's happening, repo, reverse repo, all that stuff, to find out, hey, are they struggling to come up with the cash to meet the bond sales that they committed to, et cetera? Do they have any kind of issues like that pop up? Right now they have lots of cash. Right now there's lots of bonds floating around, so they can use the bonds as collateral to get cash to do that. And then, when they buy the bonds, then these are brand new spanking assets. So I assume they can make it work for the time being, but that would be an area to watch for that kind of distress. And then the other thing is interesting, the banks have, not really had really good earnings. There haven't been really good earnings here. And it's kind of interesting because they just, they're not going to, their earnings are not going to go up. The increase in the interest in the steepness of the yield curve is not going to help them. I mean, we're not going to get an increased steep yield curve. We don't get that. The 30 years anchored like it's a boat anchor and it's just stuck at whatever that 1.52%. It's just stuck there and it's going to stay there. And you can watch, you can look at the charts and you just do they did dynamic yield curve and you're like, you just see how it just inverts because the Fed is going to push up that short-term rate. They're going to push it up and boom, they'll invert it. It gets everything all messed up. And, then they have to come in, something will break. It's always like something breaks. So I think that we're then on track. Now, if for whatever reason, I mean, maybe there's so much momentum in these markets and so much cash out there that maybe this will just be a quick correction. It could very well be. And so I have to pay attention to that as well. I don't want to be sitting there in cash and be like, we're at new time highs or whatever. This kind of thing in March was surprising how fast that market reversed to the upside after those limit down days that we had in March when the cerveza sickness was, coming out really heavy and they're closing down everything. And I remember it was silly in San Diego, they're closing down. It's so dumb. They're closing down Fiesta Island. It's like all outside on the beach. Like, why would you close that down? Like, it makes no sense. But irrelevant to that, that's what they were doing. And at that time, the market was going limit down. So we'll see what happens. This is not financial advice. Just from my point of view, I'm just going to kind of do some caution here. Really have to kind of see what happens. So I think like the rest of this week, I could see some movements and some rallies and stuff because just so oversold. And a lot of the uncertainty is now baked out of the market. It's like, okay, for the rest of this year, you have an idea what the playbook is. So now you can plan. You're like, hey, the Fed they're not going to buy any more bonds, blah, blah, blah. Sure. Is some going to roll off? Are they going to sell them? Whatever. They're going to probably roll them off, whatever. Are they going to raise rates? Yeah, they're going to raise rates a couple times. Are they going to come in and raise it like 100 basis points at a time? Probably not. I mean, there's a possibility, but basically it's sort of to plan. So that takes away that uncertainty that creates that kind of volatility in the market. Now, the question though is, well, do you want to buy it? Do people want to do new buying? Do investors want to commit more money at this point? And the answer is, that's what we have to see. In the short term though, you could see a rally because you have stuff like some of that stuff in the ARK-K and everything is so beat up. And a lot of those companies, some of them, they're not making much money. There's a risk there. Yeah. And they may not be around in 10 years, but irrelevant. They're so oversold. And if you were like someone that had shorted those things, I mean, if you shorted shift from whatever to $3, I mean, you better take some profits. And that profit taking is buying pressure. My guess is that, yeah, we're going to head into that bear market. We've already seen the behavior. Even me, Kevin, today was talking about, he was talking about how, the rallies are, the rallies that we get, the runs that we get are very short and everything. And they're not, don't have much momentum and we're losing the momentum. A video about that where he's driving in the car talking about that. And it's like, yes, Mr. Kevin, yes, that's called a bear market. It's bear market behavior. You can't buy the dip in a bear market because every time you buy the dip, the rally that you get fails. And as I've shown, it's like, you're making new lows and lower highs and you can't buy the dip on that. You got to get a base in there first before you can do that. That's it. Later. Bye.